Do you need life insurance? Which type should you get? And is it a good investment? Unfortunately, most people don't know the answers, and there is a lot of misinformation on social media. So today, I'm going to talk about life insurance and how you and your family could use it to protect and build your financial success. Hi, I'm Prudence Zhu, CPA and financial planner. I also teach personal insurance planning at Arizona State University. I'm here to inspire and empower you to build your financial freedom and live the life you want and deserve. So, first of all, what does life insurance do? It exists so that people can take care of their financial responsibilities in the unfortunate case of a death, which usually means a total loss of future income from the person who dies. It would be particularly devastating if the individual is still working and has many financial duties, such as paying the mortgage or supporting dependents. Death is unavoidable and might come when you least expect it, but financial responsibilities don't stop. On the contrary, it might even go up immediately due to the death. Medical bills, funeral costs, fees for estate settlement, and liquidity, etc. Many say that they don't have life insurance because they are still young and don't want to think about death. But the whole point of insurance is to protect you and your loved ones in case of a low probability event with severe consequences. So consider it as a necessary tool to protect the financial future of your loved ones.
Do you have life insurance? Because if you do, you could always use a little more. Am I right or am I right or am I right? Right.
I hope you got the joke. To figure out how much you need, you can approach it in two ways. First is the human life value approach. You can estimate it by taking your expected lifetime earning minus your tax liability and living costs, and then discounting the total amount to present value. It sounds like a lot of financial jargon. In other words, it is how much you are contributing to supporting your family's current and future needs multiplied by the number of years you will be working. For most people in their 30s, it can easily be more than $1 million. And that's not only for people who have paid jobs, because the value of stay-at-home parents could be more than $100,000 per year. The second approach is the life insurance need approach. This approach estimates how much the family would need if the breadwinner dies. The basic formula summarizes all current and future expenses and subtracts the total amount of existing assets. The essential point here is to take out current assets already available. So if you have already built a nest egg, you probably won't need as much coverage for life insurance. And as your assets grow over time, you might need even less. This is good news because less coverage means less premium, especially when you get older and develop some health issues. On the other hand, if you have a lot of debt, you probably would need more coverage. There are many life insurance products out there, but overall, there are two main categories: term life insurance and permanent life insurance. Temporary life insurance only covers the policy period, so it's temporary, just like auto insurance. You only get the benefits if you are insured and keep paying the premium. It has a fixed cost per month within the insurance term, and it could be for 1 year, commonly provided by employers, 10, 15, 20, 30, or even 40 years. So it's usually more affordable. For example, I am a healthy woman in my mid-30s, and I could get 1 million coverage for 20 years at $33 to $62 a month. If you are younger, it would be even less expensive. As for permanent life insurance, it covers your entire lifetime, and the policy can build cash value over time as you pay more premiums. So it's also called cash value life insurance. You can borrow against or partially withdraw from the cash value of your insurance policy for your financial needs. There are many kinds of permanent life insurance products on the market, and new ones are coming out as well. Whole life or ordinary life, variable life, universal life, which includes index universal life, variable universal life, guaranteed universal life, etc. As you can imagine, with permanent coverage and a cash value, the premium for permanent life insurance would also be significantly higher than life term insurance. Again, take me as an example. A whole life insurance with $1 million coverage would cost $852 to $882 a month. Let's make a simple comparison between the different types. Both whole life and variable life insurance have a fixed premium. However, whole life insurance has a fixed death benefit amount, but the death benefit of variable life may increase if the investment portion of the policy performs well. In addition, universal life and variable universal life allow you to decide, to a certain extent, how much premium you pay. Flexibility on how much you pay would allow more people to keep the policy in effect, even if there is an income shock or other unexpected financial needs that make consistent premium payments challenging. However, research also shows that 20% of policies lapse in the first 3 years, and close to 30% lapse in the first 5 years. Lower face amount or death benefit policies and younger people have a higher lapse rate. However, people over 65 also have higher lapse rates towards the end of the policy due to health shocks. In addition, a large percentage of people surrender their policies early. As a result, the termination rate of life policies is high. Only a small portion of the policies get executed at death. We don't know the exact cause of the high termination rate in the industry, but one thing is for sure. People who lapse or surrender their policies in the first few years would suffer significant financial losses. That's because the expenses of a permanent life insurance are heavily front-loaded. A big percentage of the premium pays for the agent's sales commission, which can be as high as 80% to 100% of the premium in the first year. Not to mention, insurance companies have all kinds of expense loading, so the cash value builds particularly slow in the first few years, and people who surrender them then would get significantly less back than what they paid in premiums. Variable universal life insurance in particular has front-end expenses and back-end surrender charges, state premium tax, investment management fee, guaranteed death benefit surcharge, and the risk of fluctuation of the investment portion of the insurance. That being said, you might already have an answer for whether life insurance is a good investment, but there are specific nuances you have to consider and pay attention to. I'd recommend getting term insurance with appropriate coverage, especially when you are still working. And you might get some coverage through your employer at a lower cost than the market. But I wouldn't consider term insurance an investment. Instead, it is a small cost to pay to protect your family and give them peace of mind in the unfortunate event of a death in the family. So I would call it a risk management instrument, not an investment. By the way, you can convert a term insurance policy to a permanent life insurance policy as long as it's not expired. As for permanent life insurance or cash value life insurance, it could be valuable for people who might become uninsurable when they retire or get older, but still don't own enough assets to fulfill their financial responsibilities when they die. It could also be valuable for people who lack the discipline to save and invest over the long run consistently. In that case, permanent life insurance is a commitment and an incentive to keep putting money away for the future. However, if something happens and they let the policy lapse or surrender it early, they might end up worse financially. The third situation will be for the ultra-rich as a tool for estate planning. They might have more than enough in other tax-advantaged vehicles and want to allocate a small portion of their net worth in insurance to pass on tax-free death benefit. If you run into insurance agents, you should ask them how much commission they make through the policy. In addition, it would help if you talked to a fiduciary financial planner for advice before you buy permanent life insurance, because they are obligated to put your best interest before their own. They would also be able to provide you with a realistic projection of the return on your investment, which might be very different from what's in the marketing materials. Also, as a piece of general advice, be very cautious about people who don't discuss your specific objectives of getting insurance and alternatives. Everybody's life and financial goals are different, and their situation change over time. So there is no one-size-fits-all insurance solution. Our family is a double-income household. My husband and I both get $50,000 life insurance coverage from our employers, which is pretty standard. And since my husband makes more money than I, he purchased an additional $2 million term life insurance when we had kids. As our net worth grows, we must reevaluate if we still need that much. And for me, I got additional life insurance that's 3 times my annual salary through my employer. That's the maximum I could get without going through medical exams. I probably should get more, but I get lazy, like many people. So maybe I should make it my New Year's resolution already. Since we're diligently saving and investing with higher returns than insurance policies would be able to generate, and we are not planning to become ultra rich, we haven't considered permanent life insurance products. I hope today's episode brought you some clarity on life insurance. If you liked it, please give it a thumbs up and share it with others. We are also available on your favorite podcast platform under Invest with Prudence. Please subscribe to my channel if you want to learn more strategies to build your financial success and live the life you want. See you next time!